Hey everyone, ready for a deep dive into the Singapore stock market with me today? We're going to break down some key happenings from November 5th, 2024. We'll touch on some familiar companies like Singapore Airlines, and we'll look at some interesting REITs. Oh, and there's even a kind of juicy story about a tax dispute. To help us navigate all this and make sense of what's happening, I've got our market expert with us. They're amazing at connecting the dots and telling us the so what behind all the numbers.
Glad to be here. The Singapore market never disappoints. Always something interesting going on.
Okay, so let's set the scene. The STI dipped just a little bit today. It closed down 0.3%. But, and here's where it gets interesting, some companies actually buck that trend. Seatrium and Dyna-Mac, they're both in that offshore and marine engineering sector. They saw gains, 1.6% and 1.5%. And then there's Thai Beverage. They were up 1%. You know, this is what I love about the market. It's never just one big blob, like everything moving in the same direction. Each company has its own story, its own momentum. It really makes you wonder what drives those differences.
It really does. And that's where understanding the specifics of each company and its industry, that's where that becomes crucial. We can't just look at the overall market and call it a day. You really need to zoom in and see what's happening.
Let's do some zooming in then. Let's start with Singapore Airlines, SIA. They announced a massive investment today. We're talking $1.1 billion to revamp their Airbus A350 fleet. That's commitment to staying competitive, right?
It is a significant investment, and it really highlights how competitive the airline industry is, especially for that premium travel market, the one SIA is known for.
Yeah, exactly. All the other airlines are stepping up their game.
Yeah.
New cabins, fancy seats, better entertainment systems. SIA has to keep pace if they want to justify those higher ticket prices.
Yeah.
They have to hold on to their market share.
That's exactly right. It's not just about the physical upgrades. It's about their image, their brand, their position in the market. Passengers expect a lot from SIA.
And they're not doing this alone, right? SIA Engineering, their maintenance subsidiary, is going to be handling the retrofitting. Pretty smart move, I'd say.
Definitely a smart move. It keeps the expertise and a lot of that investment within the SIA group. Plus, it could even open up new opportunities for SIA Engineering. Down the line, they could leverage this expertise, maybe work with other airlines.
Interesting. So how did the market react to all this?
Well, SIA shares saw a little bump, but SIA Engineering stock, that climbed more noticeably.
Makes sense, right?
Right.
For SIA, it's a long-term commitment, a signal they're serious about growth, and investors like to see that. But for SIA Engineering, it's more immediate. They landed a billion-dollar contract. Their future's looking brighter.
I love how one company's decision can have this ripple effect. It's not just their own stock, it's the companies connected to them.
Yeah, that's the market for you. It's all interconnected. If you understand these relationships, you can get a real edge as an investor. All right, let's move on to another big player, Capital Land Investment, or CLI as most people know them. They're in the real estate asset management business. And they just secured a major capital commitment from Mitsui O.S.K. Lines, that big Japanese shipping company. We're talking $261 million, flowing into CLI's funds focused on Southeast Asia and India.
This is really interesting. It shows the growing interest in those emerging markets. Southeast Asia, India, they have strong demographics, lots of economic potential. It makes them very attractive for real estate investment.
And there's more. CLI is also closing their Capital Land India Growth Fund, too. That's a $525 million fund. They've got a commitment of $131 million from Daibiru Corporation. That's Mitsui O.S.K. Line's real estate arm.
So what we're seeing here, it's a powerful combination. You've got global players like Mitsui O.S.K. Lines and Daibiru Corporation. They're looking for opportunities. And CLI, they know these markets inside and out, Southeast Asia and India. They're the perfect partner to guide those investments.
Perfect match, no surprise. CLI stock responded positively on Monday.
Investors love to see this kind of stuff. Partnerships, commitments. It shows confidence in the company's strategy.
Okay, since we're on the topic of real estate, let's talk about Capital Land Integrated Commercial Trust, CICT for short. It's a REIT. And their Q3 performance numbers were pretty impressive. Their net property income jumped 5.4%, reaching $89.8 million.
That is solid performance, especially when you consider all the global challenges out there. The commercial real estate sector has been through a lot.
Right. So what's driving this growth? Well, it's a combination of higher rental income and a reduction in their operating expenses. A good combo.
Couldn't agree more. For a REIT, this is the dream. It means they're attracting tenants, keeping their properties full, and managing their costs well. All that means more money for investors.
Okay, but let's back up a little. For anyone who's not a REIT expert, what makes them so attractive to investors?
Well, REITs are companies that own, operate, or finance income-generating real estate. Think office buildings, shopping malls, apartments. And the key is, they have to distribute a big portion of their income to shareholders as dividends. So if you're looking for steady income, REITs can be a good option.
Gotcha. So if you're looking for a steady income stream, CICT might be a good one to look into.
They've got strong performance, high occupancy rates, definitely one to keep on your radar.
But hold on, there's a little wrinkle with CICT. They're doing this asset enhancement initiative, an AEI, at their Galileo property. Basically upgrades and renovations to attract even more tenants and boost those rents in the future.
Ah, yes, AEIs, those are pretty common for REITs. It's all about enhancing the property value and increasing their income potential. But there's a flip side. Renovations usually mean a temporary dip in income. Parts of the property might be unusable during the work.
So the Galileo AEI is kind of creating this short-term income gap for CICT, but probably a smart move for the long term, especially since their overall numbers are still looking good.
Yeah, it seems like they're managing it well. They've got strong occupancy rates.
And those positive rental reversions are promising.
Exactly. It suggests they're a well-managed REIT. They can handle challenges and still deliver value to their investors. Definitely worth keeping an eye on.
Now let's switch gears a bit. Let's talk about a company that's essential to Singapore's digital world.
Yeah.
NetLink NBN Trust. They own that fiber optic network. You know, the one connecting the whole island. Their financials were a bit of a mixed bag this time around.
Yeah, a bit of a mixed bag for sure. Their distribution per unit went up a little. That's the income paid out to shareholders. But their net profit, that took an 8.3% hit.
And their revenue dipped slightly too. What's going on there?
Well, it's hard to say for sure. There were probably a few factors at play. The telecom sector is always changing. New technologies pop up, new competitors enter the market. Plus, Singapore's fiber network is pretty much built out. There's not much room for massive growth at this point.
So they've already reached most households. It's harder to keep adding new customers at the same rate as before.
Exactly. It's like hitting a plateau. It's important to look at the difference between their distribution per unit and their earnings per unit. The distribution went up, but earnings went down. What do you make of that?
It seems like they're prioritizing those distributions, keeping investors happy, even if their profits aren't skyrocketing.
You're picking up on something important there. It shows the tension that sometimes exists between keeping investors happy in the short term and ensuring the long-term financial health of the company. It's definitely something for investors to consider when they're evaluating NetLink NBN Trust.
All right, let's move on to a REIT that seems to be riding a pretty big wave right now. AIM's APAC REIT. They're all about logistics and warehouse properties, and that sector has been on fire lately, all thanks to
E-commerce. It's driving this huge need for warehouse space. Think about it. All that online shopping we do, those packages have to be stored somewhere. They have to be moved around quickly. That's where AIM's APAC REIT steps in.
Exactly. And their performance shows it. They reported a nice increase in their distribution per unit. Good news for those investors, the ones looking for that steady income stream.
It all comes back to those broader economic trends, like the growth of e-commerce. Once you understand those trends, you can start to make sense of how individual companies are performing. It's not just about the numbers themselves. It's about seeing the bigger picture.
Okay, speaking of bigger pictures, let's shift gears geographically. Let's head over to Europe and talk about Cromwell European REIT. They've got a pretty diverse portfolio, properties spread across a bunch of European countries.
And they're doing pretty well, a 7% jump in net property income.
Not bad at all. They're saying this growth is because of some strategic developments, like their Nerza 21 office redevelopment in Milan and the Novo Mesto 1 industrial park in Slovenia.
It goes to show the importance of active portfolio management. You can't just sit back and hold properties. You got to develop them, upgrade them, reposition them. Got to find ways to maximize their income potential.
And having properties in multiple countries, that's diversification, right? Helps to spread the risk.
Exactly. If one market's down, another might be up. It helps balance things out.
Makes sense. Okay, ready for a company that might be getting acquired? These are always interesting stories.
Absolutely. Mergers and acquisitions, they can really shake things up.
This one involves Dyna-Mac. They're an oil and gas contractor, and they've received this voluntary conditional cash offer from Hanwha Ocean SG. Basically, Hanwha Ocean wants to buy them.
And it looks like that offer has become unconditional. Hanwha Ocean has secured enough shares so they can take control of Dyna-Mac. The deal is very likely to happen.
So it's a done deal then?
Well, almost. There's one last hurdle. It's called a merger control condition.
What's that?
It means the regulators need to sign off. They want to make sure the deal doesn't create a monopoly. or stifle competition.
So the ownership part is basically settled. But it's not 100% final yet. We got to see what the regulators say. This acquisition could have some interesting ripple effects, right?
Yeah.
Not just for these two companies, but for the whole oil and gas industry.
Absolutely. Dyna-Mac could gain access to new resources, new markets that could fuel their growth, and for Hanwha Ocean, they could solidify their position in the oil and gas services sector.
And on a larger scale, could this be a sign of consolidation in the industry? Companies trying to get bigger to compete more effectively?
It's certainly possible. This is definitely a situation worth monitoring. These kinds of deals can reshape entire industries.
Okay, let's bring it back to something a little closer to home. Remember those home loan rates we talked about earlier, the ones that have dipped? Well, some foreign banks are offering rates as low as 2.45% if you're thinking about buying a place. Or maybe refinancing your mortgage. Now might be a good time to pay attention.
It's a topic that a lot of people are thinking about. Those lower rates can make a big difference in your monthly payments. It can affect whether you can even afford a home.
It's true. But the big question is, what's causing these rates to go down?
Well, there could be a few reasons. Maybe it's increased competition between banks. They're all trying to get your business. Or maybe it's global interest rate movements. Those can have an impact on local lending rates.
Or maybe it's a little bit of everything. Whatever the reason, it's creating opportunities in the housing market.
Absolutely. For potential home buyers, these lower rates could be a game changer. And for current homeowners, refinancing could save you a lot of money over the long term.
So it's worth doing your research. Shop around, compare offers. Don't just settle for the first rate you see.
Good.
So let's wrap things up. Let's take a moment to think about what we've learned today. We've seen companies adapting to a changing world. SIA investing in premium travel. CLI focusing on emerging markets. AIM's APAC REIT riding that e-commerce wave. Dyna-Mac potentially joining forces with another company.
We've also seen that it's not always easy. NetLink NBN Trust dealing with those declining profits. The Changi Airport Group tax case, showing how tricky those big infrastructure projects can be.
It's a mix of opportunities and challenges. Successes and setbacks.
Just like any market.
That's why it's so important to make informed decisions.
To weigh the evidence, assess the risks, and come to your own conclusions.
And that, I think, is the heart of the deep dive. We're not here to give you all the answers, but to give you the tools, the insights, so you can make those judgments yourself.
It's your journey. We're just here to guide you